This is Laura with Liberty Mortgage Lending Group in Florida. Welcome to this workshop, a step-by-step guide to repairing your credit. Thanks for being here. Let's get started. Taking charge of your credit score. Good credit is critical. Banks won't give you a loan if you have a bad credit score. Credit card companies will reject you, and insurance companies may even charge you a higher rate. If you have a low credit score, your utility company may require a security deposit before they'll turn anything on. Unfortunately, it's pretty easy to hurt your credit score. Something as simple as being late on a loan payment can do some serious damage to your score. If your actions have lowered your score, you're not alone. Millions of people have experienced the exact same thing. The good news is that you can repair and improve your credit score. You've probably seen advertisements for credit repair companies, but the truth is these companies can't take any actions that you can't take yourself. You don't even need to hire a company to fix your credit. You can do it all on your own. In this workshop, we're going to give you a step-by-step process to follow in order to repair your credit and increase your credit score. Keep in mind this is not an overnight process. Depending on how low your score is, it could take some time to improve it. But if you follow these steps, your score will improve. Don't get discouraged if things don't turn around right away because you should keep at it. In the end, it will be worth it. Are you ready to get started? Let's dive in. Understanding your credit score. Before you can begin to repair your credit score, it's important that you understand what factors affect it. There are a number of specific things that affect your credit score, and if you don't pay attention to all of them, you can unknowingly hurt your credit score. Your score will range from 300 to 850 and represents how likely you are to pay back the money that you've borrowed. In the eyes of a lender, the lower your score, the less likely it is that you'll repay the funds you've borrowed. This is why it's so important to build and protect your credit score. If you have a low score, lenders are very hesitant to give you money. If your score is under 560, you are considered to have bad credit. There are 5 factors that determine your credit score. Number 1 is your payment history. Paying bills on time is really important for your overall credit score. Late payments, having accounts sent to collection agencies, or defaulting on accounts will significantly hurt you. Bankruptcy is also very damaging to your credit score. The second thing is credit usage. Credit usage is how much of your available credit you've used. For example, if you have a credit card with a $10,000 limit and you have a $3,500 balance on your card, your credit utilization rate is 35%. A low credit utilization rate is better for your score. The third thing is credit mix. Typically, it's better to have experience with different types of credit than just a single category. All things being equal, a person who's managed both a home loan and a credit card will probably have a higher score than someone who has only a credit card. Fourth is the age of accounts. Creditors like to see that you've had credit for some time, not just a few new accounts. So older accounts generally do help raise your credit score. 5, credit applications. When someone examines your credit record to determine whether to give you credit, it's called a hard inquiry. Hard inquiries can lead to decreases in your credit score. Be very careful of when you apply for credit. As you work to increase your score, keep these 5 factors in mind and focus on the things that have had the biggest impact on your score. It's also important to understand the different types of consumer credit available to you. Generally speaking, there are 4 types of credit. Revolving credit, such as credit cards, allows you to borrow up to a certain amount every month. You're not required to pay back the full amount by the end of the month, but the longer the balance is unpaid, the more interest is added. Charge cards. Charge cards are essentially the same as credit cards, except that you're required to pay the balance in full at the end of each month. Service credit is when a person provides you with a specific service and then bills you after the fact. Everything from your cell phone bill to utilities is considered service credit. Usually service credit does not show up on the credit report. However, if you do fall behind on paying these bills, it could be recorded to the credit bureau or sent to collections, which will affect your credit score. Installment credit comes in the form of loans. You borrow a specific amount of money and then repay it over the life of the loan. Now that you understand the basics of what goes into your credit report, we can get started with the steps that you can take to repair your credit and raise your credit score. You'll follow through the program with steps 1 all the way to healthy financial habits. Thank you for joining.